Hello there, I'm Amira David. This is Boom Bust, and these are the stories we are tracking for you today. The head of the Bank of England now says a Brexit is the biggest risk to Britain's financial stability. I've got the details on that coming right up. Then David Beckworth is on the show. He'll tell us what he thinks should really be blamed for America's half-hearted economic recovery. You don't want to miss that. Plus, in today's Big Deal, Ed Harrison and I are talking about the latest indicators that show slowing growth in major global economies. Which ones stand out as the weakest links? We'll tackle that and a whole lot more on today's show. Don't go anywhere. Boom Bust starts right now. The head of the Bank of England has just described the country's potential exit from the EU as the biggest domestic risk to the nation's economy. In a question and answer period before the House of Commons, BOE Governor Mark Carney said the debate over continued EU membership could, quote, amplify risks regarding trade, investment, housing, and financial markets. Without giving a precise measure of impact, he did say that there was no question some degree of loss in business would be expected. Just this week, real estate company Foxtons cautioned that London's property market could anticipate a hit if the city were to lose its standing as a major financial capital. But outside of acknowledging the losses, Carney refused to make a recommendation on whether Britain should remain in the EU or not, and he said the bank would not do so in the future. That point, however, became contentious when one conservative lawmaker accused him of colluding with Prime Minister David Cameron to make pro-EU comments. Carney rejected that notion that Cameron or his office might have had any influence whatsoever on his testimony. Every word at this point matters as voters continue to make up their decisions in the run-up to the referendum, which is taking place on June 23rd. After meeting in Brussels, leaders from the European Union and Turkey have agreed on a new plan to take on the refugee crisis. But the strategy leaves many questions unanswered. And Boom Bust, Bianca Vicini has the details.
The most recent refugee crisis protocol orders refugees that arrive in Greece and Turkey to be returned to their home country. And for each refugee sent back, Syrians that are already in Turkey will be given asylum in the European Union. Though nothing is finalized, that's the plan leaders are hoping to execute through the end of the refugee crisis. In the process, Turkey will receive funding from the EU, at least $3.3 billion, and get closer to possible membership. Turkish citizens will also likely be given access to visa-free travel in the EU by June of this year. Donald Tusk, president of the European Council, expressed positive sentiment after the meeting, calling it a breakthrough. But German Chancellor Angela Merkel remains skeptical and said it'll be a breakthrough if it becomes reality. And the reality of this working out is not looking too great. Neither the EU or Turkey made it clear what will happen to non-Syrian refugees that are already in Turkey. Questions also remain about the resettling of refugees throughout Europe as several EU nations continually reject the quota system. Aside from the unanswered questions, the latest plan of action doesn't address safety and security. In addition to criticism from human rights groups, the United Nations went as far to suggest the plan is not consistent with European and international law.
All right, well, the Fed has used a lot of tools to get a strong recovery going, but it hasn't quite been enough to fully bounce us back. Economist David Beckworth has said that while a lot of people are blaming this on policymakers running out of ammunition, we should really be placing the blame on the Fed's commitment to low inflation. For more on that, I spoke to David Beckworth himself. He's an associate professor of economics at Western Kentucky University. I first asked him to explain the rationale behind that argument. Here's what he had to say.
The Fed's inflation target of about 2% puts a straitjacket on it. It can only use those tools to the extent they push inflation close to that. The Fed has had a target since 2012, but most research points back to the Fed implicitly adopting an inflation target in the early 90s. So I think what's happened is we've come to the point where the body politic, not just the Fed, but everyone expects there to be low inflation. So even if the Fed doesn't do it, Congress expects it. So there's just this expectation we will do low inflation no matter what. Unfortunately, sometimes you need a little bit higher inflation, temporarily higher inflation. So in 2009, 2008, that was needed.
Yeah. So you say higher inflation, unfortunately, was needed. But what are we talking? I mean, what range are we talking about?
Well, I did an estimate that suggested that 2008, 2009, if inflation had been permitted to go to about 3 to 4% for about a year and a half, total spending would have been put back to the level it was before the crisis. It would have stabilized a lot of economic activity. So the question is, could the Fed have allowed 3 to 4% inflation for a year and a half to 2 years? And I don't think there's the political support for that. And again, that's the constraint here. This expectation of low inflation is preventing the Fed from doing what it needs to do. No matter what, negative interest rates, more QE, it will only use those tools to the extent it hits that low inflation mark.
Okay, well, pushing that target up, I mean, what kind of impact would that have had on real GDP?
Well, I think in the short run, more monetary policy stimulus through tolerating higher inflation would actually have pushed up real GDP some. It may not have solved all the problems. I don't think it would have. There's still a lot of debt problems and deleveraging that would have had to have taken place, but it would have been much better. We wouldn't have had the Great Recession, could have had a more mild recession, similar to 2001 or some of the other places. I'll give you a counterexample. Israel and Australia, they both had very mild recessions. In fact, Australia didn't even have a recession. And that's because they're able to do what was needed. They allowed higher inflation.
Yeah, I want to ask you about that. I was going to go to that. You know, you say that they've implemented a similar strategy. It's sort of worked out for them. Though it has to be noted that they're very, very different countries, very different in size, very different in the sense that they're a little bit more simplified economically as compared to the U.S. or the Eurozone. So is it really easy to extrapolate that because it worked in those countries, it would work elsewhere?
Politically, no. I agree that it may be a lot easier in a country with smaller populations, more political consensus. So I agree that it's probably not fair to say, why aren't you guys as good as the World Bank of Australia or in Israel? But it does give us, at least, it suggests to us that had the Fed been more aggressive, it could have made a difference. Okay.
Well, let me go back to the high inflation because, or at least sort of making it a little bit more unrestricted. We know that high inflation, or so we've been taught, will hurt the American economy. That's what we've seen historically. So in a scenario where the Fed does sort of release that target rate, can the Fed safeguard the economy from inflation completely spiraling out of control?
Yes, and that's where the level target comes in, whether it's a price level target or my preference, a nominal GDP level target. What that does is over the long run, it anchors inflation. But in the short run, it allows a temporary catch-up growth. So going back to 2008, 2009, it would have allowed 3 to 4% inflation over those 2 years, but then it would have brought it back down to about 2% after that. So what it does, it allows for catch-up inflation or catch-up spending growth, but it still provides a long-run, what we call nominal anchor or inflation anchor. So you want a rule that allows flexibility in the short run but constrains the Fed in the long run, and that's where level targeting comes in.
Talk a little bit more about that. I mean, how exactly would it work?
Well, what it is, the Fed would say, look, if we make any mistakes, so let's say we have a price level target of 2% a year. If we make any mistakes, 1 year we have deflation, we're going to correct for that on top of the regular inflation. So let's say they had minus 2% deflation. Well, in the next year, they'd have to have 4% inflation to make up for the loss plus the new inflation that was needed. And then the year after that, they'd go back to 2%. So the difference between a level target and a traditional inflation target is the inflation target does not make up for past mistakes. A level target makes up for past mistakes, whether it's too fast or too slow.
Okay, let's go back to Australia. Okay. I'm jumping around my questions here, but we were just talking about that before we went on air, about how this is a country that's gone now close to 25 years without a recession. It's pretty miraculous. I was calling it a unicorn, and it's seemingly sort of weathering the Chinese slowdown a little bit better than people would have imagined. I mean, there was sort of some slowness, and we saw some setbacks, but they're seemingly bouncing back on some levels. What do you make of Australia's position right now? I mean, is there a bubble, do you think?
Well, there could be, but it's hard to know in real time. But it is amazing. They had 3% growth last year, which is pretty remarkable for any advanced economy at this point in time. They weathered, right, the 2008, 2009, they're weathering this commodity slowdown. And it's almost, it seems like a miracle, right? Because they're a big commodity exporter, yet the downfall in commodity prices didn't harm them. And what I attribute it to is they have a very proactive monetary policy that's supported by fiscal policy. And on top of that, they have never hit the zero lower bound. So when they started easing in 2008, their interest rate was at 7.25%. So they had a lot of room to cut. Right now, their interest rate's at 2% compared to our 0.25% in the U.S. So they have more wiggle room. And one of the key issues that comes up in macro is once you hit that 0%, conventional monetary policy doesn't work. You have to resort to these other measures. So they've never gotten to the point where we have, and in part that's because they were more proactive early on. Where my thought is the Fed kind of waited too long in 2008 to act.
Yeah, so we could have learned a lesson or two
Absolutely.
from them. Okay, so the Fed's uncertainty is definitely shaking up markets. We know that, but particularly as it relates to oil. And we've been seeing that over the last several months. And you wrote a piece about this recently saying there's sort of a causal relationship that you think is going on. Tell me about what you mean by that.
Well, the Fed, its policy influences the dollar, obviously. And if you look at the point where it started to talk up interest rates, so mid-2014 till now, it talked up interest rate hikes. Fed governors were saying, we want higher rates, higher rates, higher rates. And so markets started to price that into interest rates, and in turn, that affected the dollar. The dollar had a 20% plus raise since about that time. And on top of it, of course, the ECB and Bank of Japan, where they were going into easy mode, so we're talking tightening. So this divergence led to a strong rise in the dollar. Now, why that's a problem is there's many countries in the world that peg to the dollar, China being the most important one. Now, they have a loose peg to the dollar, but it's still strong enough that whenever our currency goes up, so goes theirs. That put a stranglehold on China. They already have their own internal problems. There's a natural slowdown going on. They got an accumulation of debt. So Fed policy effectively put a noose around China's economy. And it's no surprise to me that the run on reserves, the problems that emerged, they did about the same time the Fed began talking up rates, which then leads us to the sharp decline in oil prices. So the Fed's tightening affected China, which in turn affected the demand for oil.
Time now for a quick break, but stick around because when we return, Francis Coppola is on the show to talk about why some European banks are struggling to get their finances in order. And then in today's big deal, we'll break down the latest global growth data, which it will tell us which countries are the weakest links. That's on the other side. Stay with us. And as we go to break, here are the numbers at the closing bell.
What'd you have for breakfast yesterday? Why would you pick those shoes? How fast is your Wi-Fi? What's your dog's name? Why'd you name him that? What's your biggest fear in life? Ever been on a hayride? When's the last time you read a book? What would you say if you ever met the Pope? Who's the best quarterback of all time? What's one topping that doesn't belong on a pizza? Now, I've interviewed you too. Question more.
I'm Tom Hartman, and I'll give you what the mainstream media can't, the big picture.
There's been no charges filed against preserve, protect, and defend. Political revolution.
And when you question more, you find what you're looking for.
This is the legislature branch of the
We'll go deeper, investigate, and debate, all so you can get the big picture.
Welcome back to the show. Italian banking shares have fallen sharply since the start of the year amid market concerns about the 350 billion euros of bad loans on their books. To get her take on that, I sat down with Frances Coppola, blogger at Coppola Comment. I first asked her for what she makes of the bank's plan to sell their large portfolios of non-performing loans to private investors in an effort to ease pressure. Here's what she had to say.
Basically because what they're doing is they're encouraging them to sell their non-performing loans, and to that end the state is providing guarantees on some of them, but the ones it's guaranteeing are the best quality non-performing loans, which are the ones that the banks would be likely to want to keep. The ones they really want to get rid of, which are the bad debts, they're the ones that aren't being guaranteed. So they're going to get, kind of a penny on the euro for them, really. So I'm not sure that they've really understood what they need to do to be able to unload these non-performing loans. I think that, personally, I think that Italy's idea of creating a huge bucket, a bad bank to chuck all the non-performing loans in, was a much better idea. But the EU ruled that out on state aid grounds, I think.
Right. Well, what about other banks? I mean, let's talk about Novo Banco in Portugal. Where does that bank stand? How might that pose a challenge to the European Bank for Reconstruction and Development?
Well, I think that Novo Banco could probably be called the worst good bank in the world. When Banco Espírito Santo failed in 2014, Novo Banco was created basically as the phoenix from the ashes. What's left of Banco Espírito Santo contains all the toxic assets and the shareholders and subordinated debt holders. And then Novo Banco had the good assets and the senior debts. The senior creditors. And that looks like quite a clean separation. We now know it wasn't, because Novo Banco failed the stress test last year and was told it had to raise more capital. And rather bizarrely, instead of raising more capital by tapping the capital markets, as we might have expected, the Bank of Portugal has chosen to do so by choosing 5 senior creditors, 5 senior bond issues, to move back to Banco Espírito Santo, where they'll be wiped. They're going to face legal challenges on this. And it arguably undermines the whole purpose of the European Bank Resolution Recovery Directive. It was never intended to be used to allow a central bank to cherry-pick bond issues to wipe.
Right. And we know that banking problems aren't just an issue for the Eurozone periphery. Austria is also facing problems with hypoalpe-aldria. Talk about the main problem there that they are facing and what they can do at this point to resolve it.
Hypoalpe-aldria and its remnant, which is known as HETA, the bad bank, which is insolvent and is being in the process of being wound up, is a hugely complex legal dispute involving the public and private sectors in Austria and in Germany, and indeed in other countries across Europe as well. What's happened is we have this. Most of the creditors of what is now HETA are guaranteed by an Austrian province, the province of Carinthia. And Austria has been trying for some time now to find ways of wriggling out of those guarantees. The latest attempt was a tender offer that they made last week, where they offered senior creditors 75% of their claims and subordinated debt holders 30% of their claims. All of those creditors are guaranteed, and so all of those creditors are saying, hang on a minute, we want to be paid in full. We don't see why we should accept this offer. Not quite sure where this is going, but I suspect it's going to end up in a very, very nasty and messy court case at some point.
Yeah, but how do you move forward? I mean, how do you sort of resolve the issue?
Well, again, they've tried to use a European Bank Resolution Recovery Directive to impose these losses on creditors, and creditors are saying, hang on a minute, that was never intended for this purpose. Realistically, I think we're probably going to end up with Austria having to pay. And what the creditors have done is said we will negotiate a solution that means that eventually we get paid in full, but we're prepared to negotiate over the time that takes so that it's affordable for Carinthia and for Austria.
You know, it's a difficult time right now for the global economy in general, not just, of course, Europe. Every region of the world is sort of hurting. And because of that, we are seeing more and more bearish voices sort of come out of the woodwork, particularly in the last couple of weeks, from the Royal Bank of Scotland to Albert Edwards of SocGen to Bill White, former chief economist of the BIS, and the list goes on and on, George Soros. Do you think the outbreak of bearishness is warranted at this point in time?
Well, if it's just Albert Edwards, I would say no, because he's a perma bear. And I do feel that there is this kind of unspoken dread. I mentioned that in relation to the Eurozone, that on the face of it, the performance of the Eurozone didn't seem to warrant the bearishness being exhibited by the markets. And various economists are saying we can't see what all the fuss is about. At the same time as the markets are saying it's all going to end horribly badly. The question really is, we are seeing the unwinding of a commodities bubble, the oil price bubble of the last 10 years, and the stock market bubble of the last 5 years or so, concurrently and in a related way. And it really depends what kind of linkage that is to the economy. The linkage would come through banks, pretty much, and investors. When they take losses, which they will, is that going to cause major defaults all over the place, in which case we could be looking at another crisis? Or is it something that now we can accommodate without there being major fallout? I do think that the world economy is going to slow. I'm not convinced myself that it's going to be the major disaster that some people are forecasting.
Right. I was just going to say, it does seem like there are two camps of people forming here. Those who believe we're going to hit a recession, those who believe we're not necessarily going to. And more than that, you know, if you do think we are going to hit a recession eventually, the dispute over whether it's going to be harder or softer than 2008. And you sort of already alluded to this, but sort of where do you stand on that? Have you sort of formulated your opinion?
I don't think we're going to see another crash like 2008. I would say that. I think we are going to see a slowdown in the world economy, and I think we're going to see some countries have a very bad time, particularly the oil exporters, you know, particularly those that have not had the soundest fiscal policies either. And we were talking about Venezuela earlier, but I would add Nigeria to that list, for example. I think those countries are going to have a bad time. There are some countries in Southeast Asia that might not do too well, and I'm a little bit worried about Japan. But overall, I don't think that we're going to see the kind of huge crash that we had in 2008, personally.
Big deal time. Sitting here with Ed Harrison. We're talking about the global economy. The Organization for Economic Cooperation and Development now says it sees indicators that major advanced economies will continue to slow over the coming months. And this is just the latest data, Ed, that we've seen. We've seen a number of indications that this is going to happen. But tell me, what exactly were they looking at to make this determination?
Yeah, so they're looking at a composite of leading indicators. Basically, they're looking at economic data that will tell them what is going to happen going forward. So they're looking for specific data items that will predict how things will go going forward. And we're talking about things like new orders, things like inventories and where inventories are. And we're talking about, you know, financial markets and business confidence. Those are 4 examples of the types of things that are in there. So obviously, if business confidence is low, then they're not going to do things. They're not going to hire people. They're not going to you know, make new equipment and invest. Inventories is also another thing where if inventories are high, then they're going to have to work those inventories off before they can actually go to production. So these are the kinds of things that tell you where things are heading going in the future, and they're heading not in the right direction right now.
Okay, so a lot of factors that they look at. What countries in particular do we know of that they've sort of zeroed out as countries that are looking particularly weak?
Yeah, so there are 5 countries that I saw that I remember that they that are fairly large, that they have in their sites. The U.S. and the U.K. are definitely 2 of them. Canada, Russia is another one, and then very recently, those 4 were in their sites for a while, but very recently, Germany has actually become a country where the leading indicators are going down. And I think in particular business confidence is one of the areas that we're seeing suffer in Germany very recently.
That's really, really interesting. We've got another Fed meeting around the corner next week, actually. How do you expect this data to play in, or do you expect it to play in at all as Fed policymakers, you know, figure out what they're doing next?
I don't think it's going to play in, I mean, except to the degree that it confirms some of the things that the Fed has been seeing themselves. They're not really concerned with external data. They're trying to churn the data from the U.S. itself. So to the degree that the U.S. is one of those 5 countries and the Fed has been seeing soft data, which they have, obviously financial conditions deteriorated in January and February, which is after December, they're going to use that to actually decrease their expectations for rate hikes. I don't think they're going to hike in March. But let me say this, that the market is saying by the end of 2017 that they see the Fed on average at about 0.9%. The Fed in their dot plot, which they show in terms of if things continue as they are, they said 2.375% by the end of 2017. So that's a huge difference of 1.475, which is almost 6 hikes. So the Fed really needs to, start to come down in terms of what their trajectory is, what they're saying their trajectory is, because the market is telling them that the conditions in the United States are not sufficient to support that kind of rate hike regime.
What about Europe? I mean, we did mention the UK, Germany, 2 countries, in the top 5 as far as countries of risk. Where do you think Europe would stand on this?
I think that Europe is definitely slowing down, without a doubt. We spoke about Finland yesterday, but now Germany, which is the growth engine for the Eurozone, they're in there. So I think that Mario Draghi, when he meets next week, when the ECB comes out, they're going to come out, they're going to have the big guns out. They're definitely going to do something, and probably QE, quantitative easing, they will probably take their rates more negative interest rates. Now, personally, I don't think that's going to be helpful. But, what else are they going to do? Fiscal stimulus is off the table.
Okay, but what happens if that doesn't work?
Then if it doesn't work, as I was saying, fiscal being off the table, then you're going to have big problems. Because, the EU is a fixed currency zone where it's not like you can devalue, okay? Number 2, they also have strict fiscal rules that keep people from spending, government spending going up too far. Mm-hmm. So that's not going to work either. The only thing they can look for is internal devaluation, which means cutting wages and prices in order to make yourself more competitive on an external basis so that you can get more trade. You can, make your trade balance better.
Yeah, I mean, we talked about that with Pavlina Cherneva about the lack of fiscal space in the Eurozone. Tell me a little bit more about Finland. You mentioned Finland. We talked about it yesterday, but we didn't talk about it much, and we only have a few seconds left. But tell me, is that what we can expect?
Yes, Finland is the poster boy for what's going to happen. Everyone talked about the southern flank, but Finland, they're going to need wage and price pressure, internal devaluation, and that's going to suck out demand out of the economy, and they're not going to do well.
All right, we'll leave it there. Ed Harrison, thanks so much. We love hearing from you guys. Tweet at all of us, Edward NH, Bianca Ficini, Amira David. And remember, you can see all the segments featured in today's show on YouTube, youtube.com/boombust.